Hey, welcome in. Grab a seat. It's absolutely fantastic to have you here today. As your advisor, my primary goal is to guide you through a very specific and honestly a highly effective way of looking at your finances. Today, through this explainer, we're going to pull back the curtain on the architecture of wealth preservation. We're talking about the sophisticated and entirely legal world of tax mitigation that the ultra wealthy use to preserve their fortunes across generations. The secret isn't about breaking the law. No way. It's about mastering the tax code precisely as it was designed to be used. Here's our agenda for today's session. We're going to step-by-step design your new wealth architecture. We'll start with the architecture of wealth itself, then move into the realization principle, break down the famous buy, borrow, die strategy, explore the real estate shield, look at strategic business structures, and finally wrap up with thinking like the 1%. Let's get right to it. Part 1. The architecture of wealth. Mastering the rules of the game. Now, I want to establish right out of the gate that we are not breaking any laws here. Actually, we're doing the exact opposite. We're perfectly structuring your assets and your liabilities so that you pay exactly what is required by the government, and not a single penny more. Which brings us to part 2, the realization principle. The foundation of high net worth strategy. This is literally the fundamental bedrock of the tax code that makes all billionaire strategies possible. To really grasp this foundation, I need to pose a pivotal question to you. How do billionaires actually grow their immense wealth without paying income tax? Seriously, think about it. I really want you to completely reframe your understanding of what income actually means in the eyes of the IRS. Okay, let's dive into this. The answer lies in the realization principle. Under U.S. law, the growth in the value of an asset, whether we're talking stocks, real estate, fine art, whatever, is not considered taxable income until that asset is actively sold or exchanged. So if your portfolio grows by tens of millions of dollars, that asset growth simply does not equal taxable income. You haven't realized those gains. It's like a giant paper fortress. This is exactly how billionaires can watch their net worth skyrocket while reporting, very little actual income on their tax returns. All right, part 3, buy, borrow, die, the core strategy. This right here is the holy grail framework utilized by folks like Jeff Bezos and Elon Musk to access their wealth without triggering a massive tax bill. Let's walk through this 3-step blueprint together. Step 1 is buy. You acquire appreciating assets and just hold them long term, letting that wealth compound completely untaxed. Step 2 is borrow. Instead of selling assets for cash, because remember, selling is a taxable event, you use your assets as collateral for securities-based lines of credit, or SBLOCs. And step 3 is die, passing those assets to your heirs. Now, what's really interesting about this strategy is how the loan proceeds in step 2 bypasses taxable income completely. You get the liquidity you need, often at interest rates way lower than the capital gains tax rate, all while your underlying portfolio just keeps right on growing undisturbed. To put this into perspective and give you a real-world sense of the scale we're talking about, just look at this number, 57.7 billion. Yes, billion with a B. Elon Musk has pledged some 92 million Tesla shares, worth approximately this staggering amount, as collateral for personal loans. By borrowing against his assets, he gets immense personal liquidity, without selling his shares and triggering an absolutely astronomical tax event. And here is the final phase of that cycle, the die step. When the owner passes away, the assets go to their heirs with what's called a stepped-up basis. Basically, the tax basis of the assets is completely reset to their fair market value at the date of death. This effectively wipes out a lifetime of capital gains taxes. Poof, gone. The heirs inherit the assets tax-free, finalizing this incredible cycle of compounding wealth. Moving on to part 4, the real estate shield, the paper loss advantage. Real estate acts as a uniquely privileged asset class within the American tax code, and this brilliantly illustrates exactly why. There's a crucial disconnect here. On one side, your property's actual market value is soaring, but on the other side, in the eyes of the IRS, your property is depreciating. The IRS allows owners to deduct depreciation as if the building is just actively losing value over time. This gives you outsized deductions while your asset actually gains value in the real world. Let's ground this abstract tax code in some visceral reality. Take real estate developer Stephen Ross, for example. He reportedly doubled his net worth by $3 billion over a single decade. Yet, during that exact same time, he reported negative income on his tax returns. This showcases the immense shield-like power of these outsized real estate deductions. You're generating immense wealth, while on paper, you're showing a loss. And this shield recently became even stronger. Under the One Big Beautiful Bill Act, or OBBA of 2025, 100% bonus depreciation was permanently restored for qualifying property placed in service after January 19, 2025. What this means is investors can immediately deduct the full cost of equipment, fixtures, and certain building components right away in year one. This legislation acts as a massive accelerator, allowing you to capture these upfront paper losses immediately.
Part 5. Strategic business structures, dictating your tax liability.
So, we've talked about your investment portfolio in real estate. Now let's look at how the structural blueprint of your business serves as a vital shield for your capital, specifically through S corporations. Because how you structure your business dictates your tax liability. With an S corp, you can intelligently split your income streams. You pay yourself a reasonable salary, which, yes, is subject to standard payroll taxes. But the magic happens with the rest of your revenue. You take the remaining profit as shareholder distributions. And those distributions, they're completely exempt from Social Security and Medicare taxes. By simply separating your salary from your distributions, you can save thousands in payroll taxes every single year. And if you're a startup founder, the numbers get even more interesting. So the crucial point is this figure right here, $15 million. Under Section 1202, which was updated by the OBBBA of 2025, there is an incredible 100% exclusion of capital gains on qualified small business stock, or QSBS, up to $15 million. The catch? You just have to hold the stock for at least 5 years. That is up to $15 million of tax-free capital gains simply by utilizing the correct business structure. Finally, Part 6, Thinking Like the 1%, the Master Plan. It's time to bring all of these strategies together to finalize your master plan for long-term wealth preservation. Listen, legal tax avoidance is fundamentally a strategic choice. It's characterized by total transparency and the legitimate use of deductions and credits that the government specifically provided to encourage investment and economic growth. Utilizing these frameworks, whether it's SBLOCs, bonus depreciation, or S-Corps, focuses purely on maximizing your after-tax wealth accumulation, all entirely within the established rules. The ultra-wealthy succeed because they don't look at their wealth through the narrow lens of a single year, they look at the horizon. So as your advisor, I want to leave you with this final provocative question to conclude our consultation today. Are you ready to stop planning in tax years and start planning in decades? By adopting this multi-generational mindset and utilizing the powerful shields we've explored in this explainer today, you are now fully equipped to move toward a truly tax-efficient financial future. Thank you so much for joining me.